Now, how can we use the same approach to characterize the weights and payoffs of a portfolio of assets? This is what we're going to talk about in an example. So, what is a portfolio? At bottom, it's simply a collection of assets. These could be stocks, these could be bonds, derivatives, any sort of investable asset. So let's now look at two assets that we could potentially include in our portfolio. One of them, let's say, is a common stock, and another is a bond, and not just any bond, but a very safe bond, a treasury bill. So how does the stock behave in these three different states? And let's say the probability of the states is the same. If the economy is in a boom state, well, the stock gains a lot, because remember, the stock is a residual claim. If things are really good, then there's a lot left over for the common shareholder. The bondholders are all paid off, so the stock gets a big gain of 20%. If the economy is in a neutral state, the stock gets a more modest payoff of 10%. And if there is a recession, the stock actually gets a payoff of 0%. This isn't to say the stock is wiped out, because remember, this is not a negative return. It simply means you don't get any gains. And all of these states are equally likely. So then if we draw an analogous tree for the really safe bond, remember this is a treasury bill issued by the US government, we can represent the idea that it's super safe by actually assigning the same payoff to all possible states. So let's say that no matter what happens, boom, neutral, or recession, you get 4%, which is certainly consistent with default-free fixed income. If this were a corporate bond, then maybe in a recession state, there might be some chance you would get less than 4%, because some companies may actually not be able to pay off their fixed income obligations in a recession. But since we assume this is riskless, indeed the payoff is the same, it's always 4%, and it'll never be more than 4% either, right? Because it is a bond. It's a fixed income contract, the rate of return is specified in the very beginning. So what happens if we build a portfolio of these two assets? Well, essentially we have then one choice variable to decide on. The weight that we will assign to the risky asset, and then of course 1 minus that will go into the riskless asset because our portfolio is going to be fully invested. We don't really have, in this simple model, a cash account, a money market account that we might keep uninvested cash in. So whatever doesn't go into the risky asset, by definition, must go into the riskless. So let's think about some potential weightings that we could consider. The first of these is going to be what we call an aggressive investment strategy. And the reason that we call it that is because we're going to put 75% of our portfolio in the risky asset and only 25% in the riskless asset. Now, what does this mean? That means that our portfolio payoffs in terms of returns are essentially just going to be the weights that we assign to each asset times the payoff of that asset for each state. Because remember, payoffs, returns, they're linear in portfolio weights. Whatever fraction of your assets you allocate to a certain position, you're just going to multiply the returns from that position by the weight, add up all the weights, that gets you your portfolio return. So in the boom economic state, 75% of our portfolio is in the stock. The stock gets a return of 20%. 25% is in the T-bill, that gets a return of 4%. Adding those two up, 75% of 20 plus 25% of 4 gets us a total return, if the economy is in a boom, of 16% for this aggressive investment strategy. And remember, since this happens in the boom state, there's a third of a chance of that happening. A third of the time this will happen. What about the neutral state? Well, again, 75% of our position is in the stock. In the neutral state, the stock earns 10%. The remaining 25% is in the bond. The bond earns in the neutral state 4%, but it earns 4% in literally every state. But now we multiply 75% of 10 plus 25% of 4, and we get 8.5% as our return in the neutral state, and again, 30%, well, 33.33 repeating percent chance of that happening. And finally, if we are in the recession state, a third of the time that will happen, well, we take 75% of the payoff to the stock in that state. The stock, of course, earns 0 then, and 25% chance, 25% weight on the bond's payoff in that state. And the bond earns 4% in that state as well. That gets us 75% times 0 plus 25% times 4, 1%. So you can see why we call this an aggressive investment strategy. It wins big if the economy does well. You get 16% returns. And it loses, or I mean, it just doesn't do terribly well if that doesn't occur. If you get a neutral state, you get 8.5%. If you get the recession state, you actually underperform the risk-free bond. You only get 1%. Now, similarly, we can then imagine what a more neutral investment strategy would be like. If an aggressive one puts a lot of weight on the stock, we can maybe be less aggressive and more safe by simply putting less weight on it. So let's say that we have another strategy where we assign a 50% weight to the stock and 50% to the bond. What would the returns by state be then? Well, now we have updated weights of 1/2, but otherwise the procedure is analogous. We multiply the payoffs to the stock and the bond by the weights in the portfolio, 50-50 now, and we add them up by state, so 12% if the economy is in a boom, 7% if it's neutral, 2% if it's in a recession. So you can see how this is a bit more safe, because yeah, we're giving up a lot of upside if the economy enters a boom. In fact, we're underperforming our aggressive strategy somewhat if the economy is neutral, but we actually do, well, twice as well if the economy is in a recession. So if we're really worried about sort of the downside, this would be a way to protect us against that in a way that the aggressive strategy can't. And finally, if we're even more worried about the downside, we can indeed assign a greater weight still to the risk-free asset, to the bond. So let's say we put 75% of our portfolio in the risk-free bond, only 25% in the stock. Now our weights are 1/4 and 3/4 respectively. We again multiply the stock and bond payoffs by these new weights, add them up, and now we see that we've actually given up a great amount of the upside if the economy does enter a boom, and we still do somewhat less well than the other strategies if it is in a neutral state, but now we actually get the highest payoff if it enters a recession. So you can sort of think of this as being the least risky portfolio allocation of these three that we have considered, simply because it doesn't have as great a variety in outcomes. which sort of ties us back to our discussion of distributions, mean versus spread, right? Obviously, the mean payoff to the aggressive strategy is the highest, but the spread is high as well, whereas the mean payoff to the conservative strategy is the lowest, but the spread is also low. So let's sum up. We actually have 5 potential strategies to consider now. We've got the one where we invest all of our weight, all of our portfolio in the risky asset, getting simply the risky assets payoffs, the stocks 20% in the boom, 10% neutral, 0% in the recession, and analogously 100% in the riskless bond, getting 4% no matter what the state is. And these 3 combinations that we've made, the aggressive, neutral, and conservative portfolios, the different weightings on the stock and the bond. So the first thing that we can see is we can actually create whatever payoffs, or maybe not whatever payoffs we like, but certainly a substantial variation in payoffs by adjusting this portfolio weight between the risky and riskless assets. We can make payoffs that have higher magnitudes but greater dispersion, as well as ones that have, well, hardly any dispersion, in fact, no dispersion at all. But looking at these payoffs across states is a bit cumbersome. You know, how do we exactly compare 2010 0 to 8 6.5 3? Well, this is exactly why these 2 characteristics that we talked about in the beginning of this discussion that investors really care about come to matter. We can simply think about the expected return to the portfolio and the standard deviation of the portfolio, and just use that to summarize the returns across all of these 5 strategies. So since there's a third chance of each of these states occurring, we can actually compute the expected return as sort of the probability weighted return to the asset or to the portfolio in each case. And we can compute the standard deviation of these payoffs as well. So let's do that. All right, so let's get the means and standard deviations of these portfolios. So remember, we've got a 33% chance of each of these states happening, so getting a mean or an expected return should be fairly straightforward. For the risky portfolio, it'll be the return in the boom state times the probability of the boom state, and let's make this a static reference so it'll make our subsequent calculations later easier. Plus the return in the neutral state times the probability of the neutral state. Again, let's make this a static reference. And finally, the return in the recession state times the probability of the recession state as a static reference also. And that gets us an expected return of 10. And now we can actually just drag this over to get the expected return for each of the other portfolios. And unsurprisingly, sort of the greater our allocation to the risk-free bond, the lower our expected return. Now what about our risk? Remember, our measure of risk is going to be our standard deviation. How do we actually compute standard deviation? This is a bit of a preview of our next topic. It's going to be a sum of square differences from the mean. And I guess the square root to get the standard deviation. So we're going to say it's the square root of the probability weighted. So let's say probability of the boom state, square difference from the mean. So that would be 20 minus exponentiate it, and an analogous square difference, again as a static reference. Difference from the mean of the neutral state payoff squared plus the probability of the recession state times the square difference from the mean. Now remember, this is the mean of the specific portfolio in question. In this case, the mean return is 10. So now we've got these probability weighted sum of square differences. We're adding them up. We're taking the square root, and that gets us 8.16%. And if we drag that over, it shouldn't surprise us, first of all, that the standard deviation of the riskless portfolio is 0 because there is no deviation from the mean. But also now we see that each of these portfolios is decreasing both in expected return and also in risk. Okay. And then the other example of using payoff trees is actually really where they are used most often in the industry, which is in options. What we can do is we can actually represent the payoffs to the option using an event tree. And here's how we do it. Let's say that we still have that same three-state environment where there's a third of the time a boom or a neutral or a recession state occurring. And let's say that we have a stock that's currently worth 40. Let's change the payoffs a bit so that instead of getting a 10% return, we're just going to say that the stock gains $20 in the case of a boom, gains nothing in the case of the neutral state, and loses 20 in the case of a recession. Now, we can draw the payoffs, therefore, to the stock very easily. They'd be 60, 40, and 20. Now, what if we actually conceptualize what the payoffs to a call option on this stock would be? Remember, a call option from our financial assets discussion is an asset that is the derivative of the stock's value, and it gives you the right to buy the stock for a certain pre-specified price. Let's say the strike price is 45. And remember, since the option gives you the right, that right has some positive value. Therefore, the option has some positive price that the owner of the option has to pay for it. Let's say that's $5. So what then are the payoffs to the option in these same three states? Well, in a boom state, the stock goes up 20, goes to 60. Remember, the option gives you the right to buy it for 45. Would you buy something that is worth 60 for 45? You would. And how much is your gross payoff? Well, you paid 45, you got something worth 60, you get 15. Now, would you buy something worth 40 for 45 in a neutral state? Well, probably not. Therefore, you don't exercise the option, your gross payoff is 0. Because remember, the option gives you the right, but not the obligation to actually exercise it. So you would rather just not do anything. Similarly, for the recession state, you certainly wouldn't want to pay 45 for something the price of which is 20. So the gross payoffs to the option are 0 in both of the lower states. But we should also account for the fact that we had to pay $5 for this option. So really the net payoff would be whatever the gross payoff is minus the option premium, minus that $5. So that would be 10, -5, and -5 in the three cases respectively, because remember, even though you didn't exercise the option in the neutral or the recession state, you still had to pay for it. So that means you're out that $5 in premium no matter what. It's just that in the boom state, you do actually exercise the option, you gain $15, so your gain is simply reduced by the amount you had to pay for the premium. But the premium is paid in all cases because the premium is actually paid in the very beginning of the option contract. It's essentially a sunk cost. Similarly, what would happen if we had a put option with a strike price of 35? What would the payoffs to that be? Well, remember, a put option is an option that gives you the right to sell for a certain price. The strike price is 35. So you have the right to sell this stock, and we can think about whether you would or not. If the economy is in a boom, would you sell something worth 60 for 35? No. So you do nothing, your payoff is 0. Would you sell something worth 40 for 35 if the economy is in a neutral state? No. So your payoff is 0. And finally, would you sell something worth 20 for 35 in the recession state? You would, because you make 15 bucks. But what is your net payoff? Well, again, you subtract the option premium. Let's say that the option premium, again, is $5. In the boom state, you're out 5. In the neutral state, you're out 5. And in the recession state, you're still out 5, but you made 15, so therefore your net payoff is 10. So we can actually apply options to these payoff trees to create new payoff distributions. And in a way, this is what makes derivatives so attractive, that you can transform the payoffs that occur to an underlying asset or even a portfolio into different payoffs that, for whatever reasons, an investor may find more attractive. Thanks for listening. We'll talk about the statistical concepts part next.